So everyone hears all the time like, oh, the market's up, market's down. Well, what the heck are they talking about when they say the market's up or the market's down? They're typically talking about something called the S&P 500. So we're going to talk about those different indices in the equities and fixed income market that we use as just like short code for the market. So the specific question we got was, can you explain the different indices, SPX, FTSE, FTSE? It's FTSE, right? FTSE?
I think so.
The DAX, the NASDAQ. You guys have probably heard of most of these. Sadly, rest in peace, the Lehman AGG, that was then the Barclays AGG, that is now the Bloomberg AGG. I still call it the Barclays AGG. The artist formerly known as the Lehman AGG. The question was, as an investor, why would you look at indices? What do they mean or represent? And why do we have them? Yeah. So let's start with that and we'll go from there.
This seems like such a simple question, and there is a lot that we can get into. And so we're going to take the opportunity to get into all that other stuff that was not explicitly asked, but there's a lot of really kind of cool things that we can get out of this question.
So I mean, listen, guys, like you all know that I'm an English major by now, but I actually did take one econ class in college with Professor Gordon Malkiel, and he wrote the book A Random Walk on Wall Street, or Random Walk Down Wall Street. I forget what it's called. But basically the premise of that book was that all of the things that like we talk about on here, like market timing or fundamental analysis or technical analysis, that all of that is just garbage. And basically like you can't beat the market. So that the best long-term investment strategy is just to buy a diversified portfolio of assets that reflects the overall market and just hold it forever. That's basically the theory of that book. And listen, for the average person, AKA me, right? I don't specialize in actively managing my own money. Okay, so that's probably true for me. I probably should just invest like that. Most people want just overall market exposure. Okay, they don't want to be doing the research and taking on the risk of investing in individual stocks and bonds because they don't have that asymmetry of information, right? They're not specialists in that. And that's where these indices come in handy. You can buy into a mutual fund or buy into an exchange traded fund, an ETF, that gives you exposure to something like the S&P 500 or the Barclays AGG and get the returns of the overall market in your portfolio. So that's kind of how they evolved and why they exist.
And you might hear the S&P, like what the heck is the S&P? Literally, it is just an index that tracks 500 of the largest U.S. companies.
Like someone somewhere was just like, well, we're going to pick these companies and we're going to put them all on a list.
Although there is criteria. So companies can go in and out of that list. Off the bat, to even get into that index in the first place, you actually have to be a pretty decent company because you have to have a certain size. So that is measured by what's called the market capitalization. So share price times the number of shares, something like at least 250,000 shares trade, blah, blah. There's a number of things. And you have to have a positive sum of your prior 4 quarters earnings. So off the bat, this is going to mean that the companies that are in here are probably a little bit better than some of the other stocks that are out there. So it's not exactly a perfect measure of the market, but it actually almost gives you
market.
Right. Yeah. So that's just the S&P. Now the NASDAQ is going to have more technology companies, although it does have other stuff in there. So different indices are a little different.
So the Bloomberg AGG is basically what the S&P 500 is for bonds. So in order to be in the Bloomberg AGG, it also is a market cap weighted index for those corporate bonds in there. There has to be at least 100 million in par value outstanding of the bond. You've got to have at least 1 year remaining to maturity. And there's got to be a minimum of an investment grade rating on that bond, which is, I think, BBB- on S&Ps and Baa3 on Moody's scale of
So
ratings.
investment grade? Yeah.
Investment grade. Yes, exactly. Yeah. And by the way, like about a third of the index is US Treasuries. So it's going to be really highly correlated to the direction of monetary policy, all that fun stuff. There's also like agency bonds, MBS, ABS, mortgage-backed securities, asset-backed securities in there, in addition to corporate bonds.
Right. But why do you care? Like, why do you care about this?
Exactly.
And so as an investor, and like we can kind of bucket it into, are you an individual investor who has now had a couple of years under your belt in investment banking and you're starting to build your savings and now you want to put it to work? Or are you a pension fund with billions of dollars that you now want to invest and you need to now go allocate your money?
So an institutional investor.
Exactly. So retail is like you and me, and institutional is going to be the people that have a crap ton of money. Back to your point, Jen, you were like a random walk down Wall Street. You want to have diversified investments. So when we're talking about returns, you typically will use the indices as like a benchmark. So it is a reference against which performance can be evaluated. And so there's actually, and Jen has talked about the Greeks. And so if you're following any of our social media, you might have seen alpha, you might have seen beta. So alpha by definition is literally just the excess return over a benchmark, right? So the excess return over the S&P 500 or over the NASDAQ. Whereas your beta is your correlation to that benchmark. And the reason we care about this is these pension funds, for some of like the long only like mutual funds, they are looking at the return in excess of that benchmark, right? So the alpha.
They're looking at their alpha. Yep.
Exactly. They're looking at the alpha. Now, hedge funds, they actually don't care about how it performs relative to the index. They're looking at the absolute return because, by the way, they're investing in hedge funds so that it is not correlated to the index, right? I mean, I guess it could be a little bit, but
it depends on,
it depends on the mandate, right?
Yeah,
right. Back to like our endowment or our pension fund. They, like we said, have this crap ton of money and they want to invest it. And they're going to maybe take, say, 35 to 40% of their money and they're going to want to put it into equities, right? Into long only. They're going to take some percent, call it 10 to 15. They're putting it into bonds. They're taking some percent, call it 30 to 35 is going to go into what are called alternatives. So that is private equity, that is your hedge funds, that is real estate, etc. And so when they are investing in equities, they want to have exposure to what the market is doing. Like that is by definition what they want. And so that's why these mutual funds are measuring their returns relative to how does the market perform. And what they want to do is they want to have performance that is in excess, right? So above the benchmark, that's what they care about. Whereas with our hedge funds, they are just trying to make money regardless of what happens to the S&P. I mean, again, depends on the strategy, but there are these mandates. These different funds have a mandate because they're institutional investors, the people who are giving them money, they're investing for those reasons. It is because they're trying to have this diversified book. But that's why as a institutional investor, that's where the indices come in and are so important. But as a person, like if you are just your random person who's like investing, taking your 401k money and you're like, I want to put this in.
You can't buy and sell S&P 500s. You can buy and sell shares of a mutual fund that invest in the basket of companies that underlies the S&P 500, or you can buy shares of what are called exchanged traded funds. They're ETFs. So they are not the same as an index, but they give you exposure to that index. They are an investment vehicle that gives you that exposure. Just like everything else, some ETFs are super diversified. Some are super specialized and concentrated, okay? And some are designed to provide institutionally priced leverage to retail investors. If you've ever heard of like the double short long bond fund. Okay, if I'm an individual investor, for me to get twice the exposure of being short a 30-year US Treasury, like you better be, I don't know how you sleep at night, right? If you're an individual person with that kind of risk, okay? But you can buy or sell shares of this ETF that gives you a return based on hypothetically having that exposure. Same thing with S&P futures. You can trade futures on the S&P 500, but then you've got margin calls, you've got a lot of leverage, and the minimum contract size is pretty big. So that's not accessible for most retail investors. But you can buy shares of SPX, which is the ETF that tracks the S&P 500. So the other cool thing about ETFs relative to, say, buying into a mutual fund that then gives you the same return as the S&P 500, or that's their goal, ETFs price all day. So you can trade them intraday versus mutual funds that price once a day. There's also different tax treatment, but taxes are not my thing, so I don't want to get into that.
And the fees, ETFs are great because the fees on them are really low. So as you
versus
think about
paying
like
a hedge fund 2 and 20.
Yes, right. So the hedge fund is going to literally take 2%. You invest $100, 2 of that is now gone. You have just lost that because they are managing your money. Whereas like with the ETFs, it's basis points.
Oh, it's way less than basis points at an ETF. It's nothing in
Really?
an ETF. A mutual fund is lower. Yeah, ETF fees are nominal.
Wow. So yeah. So yay, ETFs.
I think it's mutual funds that you're thinking of as being basis points. But hopefully this gives you guys like a little bit of a crash course in why you would use these indices and why they're so important to the market.
Yeah.
I think we've covered indices.